people have been talking about, look, it's either going to be one and done or one and maybe a bit more work to do, possibly in September. I know you think that the Fed shouldn't even be hiking at all come Wednesday. Why so?
There's what they should do, what they will do. We've been saying, the inflation trend is coming down, that they don't have to be as tight as they are, but we're looking at some different alt data in terms of what's happening in housing. Now, housing's been firming the last few months in the Case-Shiller data. We're going to get another indicator this week on that. But our numbers, like what we see is real-time inflation is way less than what the official inflation says. And so we would say they could pause. Now the question will be, does inflation resume? Are there more indicators that maybe the economy is, we've been surprised how robust it is. So in some ways, we're upgrading our forecast for the economy, which just means higher for longer. But we would like them to be pausing after this last hike.
Okay, you think they should stand pat. Do you think they will, though?
Well, they're definitely data dependent. They've been able to navigate this in some ways without the unemployment rate ticking up, without job losses coming. You could say they've so far navigated it well. Now, the question is, are the banks really as healthy as the short term looks like? The banks reported good earnings. The regional banks have been doing okay. That's where the expectations are being down the most. I still have some fears about the small banks, that they're not passing along the appropriate interest rates. It looks fine for now, but that could come back as another worry later. But for now, it looks like the Fed's navigating this well, and inflation is trending back in a good direction.
All right, so when you think back to March, that was only 4 months ago, but it seems like an eternity, right, Jeremy? And obviously, most of us who follow markets still remember what happened then, the whole crisis, SVB, Silver Lake, Signature, et cetera. Obviously, we hope there's been a bottom put under it. But when you take a look at loan growth and credit, et cetera, people have some second thoughts. And then when you layer on top of that, the provisioning that's going to be coming soon, this is Basel III we're talking about, that only applies to the biggest 8 banks, right? The small regional ones. They're going to be exempt from that, which will leave them more fragile and also more vulnerable. So what I'm leading up to is a key question that I think a lot of folks want to know, and that is, do you think there's going to be another small or regional bank blowing up?
Over time, I do still have some worries. And now in the short term, the money supply was declining. It was one of our big worries, was how sharp the money supply was declining. It's one of the things that led us to believe there's going to be a lot of inflation. And as it started coming down, that was in some ways people leaving the banks, going to money market funds where they could earn 5% today in the U.S. That has stopped declining. We're going to get another indicator again this week on that. My worry, though, is that they're still not paying the appropriate 5% that you could earn in treasuries. And so that pressure is alleviated for now, but I don't think it's gone forever. So we've called it sort of a bank walk over time, that people are going to keep moving towards these 5% rates. The cost of deposits should go up, and that could put pressure on the banks again later this year.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.